Hi, and welcome to Early Retirement Roadmap, the show where I help you prepare for and thrive in early retirement. Monthly dividend exchange traded funds sound like the holy grail in retirement, right? Money hits your account every month. It feels like a paycheck, and you don't have to sell shares. But here's the no-nonsense truth. Monthly is just the distribution schedule. It doesn't make the investment safer, and it doesn't guarantee the income will be stable. In fact, the paycheck feel can hide trade-offs that matter a lot in early retirement, especially taxes and flexibility. So today I'll walk you through what monthly dividend exchange traded funds or ETFs really are, the main types you'll run into, and the 3 tests I use to decide if they belong in an early retirement plan. And yes, we'll touch the thing most podcasts dodge, how forced monthly income can complicate modified adjusted gross income or MAGI if you're using Affordable Care Act or ACA health insurance. All right, when people say monthly dividend ETF, they usually mean an ETF that pays a distribution every month. That distribution can be made up of stock dividends, bond interest, option premium, or sometimes return of capital. And that mix matters because it drives both your taxes and your long-term results. Now, why is this topic exploding with interest? Because monthly cash flow feels like a paycheck replacement. I get it, it's comforting. The problem is that comfort can lead people to skip the under-the-hood questions, so let's fix that. Most monthly income ETFs fall into 4 buckets. First are covered call or equity premium income ETFs. You may have heard of JP Morgan Equity Premium Income ETF, JEPI, JEPI, and JP Morgan Nasdaq Equity Premium Income ETF, or JEPQ. You'll also see the Global X covered call funds talked about a lot, like QYLD, XYLD, and RYLD. These are designed to pay regular distributions, and they typically pay them monthly. The simplest way to think about a covered call ETF is this. The fund owns a bunch of stocks like a normal stock fund, but then it does one extra thing to generate cash each month. It basically rents out some of its upside. Here's what that means. A call option is a contract where someone pays you today for the right to buy your stock from you later at a preset price. That preset price is called the strike price. So when the fund sells a call option, it's agreeing to this deal. Sure, you can have the right to buy these shares from us later at this price. And the money the fund receives up front for making that deal is called the option premium. That premium is real cash, and the fund can use some of that cash to help pay the monthly distribution. Now here's the trade-off. If the market is flat or only up a little, this can look great. The fund keeps collecting those premiums. But if the market takes off in a strong bull run, the call option can kick in, and when it kicks in, it's like the fund already promised. If prices rise above this level, we're giving up some of that extra upside. In plain English, once the stock price moves above the strike price, the fund doesn't get to fully enjoy that extra climb because the option buyer has the right to buy at the lower preset strike price. That's why covered call funds often look good in sideways or choppy markets, but can lag in big bull markets. Bottom line, you're not getting free income. You're making a trade, swapping some potential upside for more cash flow now. And that's why I say this isn't a magic income machine. It's a stock portfolio with an options overlay layered on top. Second are high dividend stock ETFs. Now this one sounds fancy, but it's simple. And just to make it real, names you'll hear in the monthly income conversations include SPHD, DIV, and SDIV. Start with the Standard & Poor's 500 or S&P 500. That's basically a list of about 500 of the biggest U.S. companies. A high dividend ETF starts with that list, then it filters it down. It screens for the companies that pay higher dividends than the rest, and it builds a fund that owns more of those higher dividend names. Then, as those companies pay dividends, the ETF passes that cash through to you on a regular schedule, sometimes monthly. Now, here's the part that people miss. That monthly cash isn't being created out of thin air. It's just the dividends from that particular slice of companies paid out to you. And because you're only buying a slice of the S&P 500, you're making a bet whether you realize it or not. In investing lingo, that bet is called a tilt. You're tilting away from the full market and leaning more towards dividend-heavy parts of the market. That can be totally fine. Just expect it to behave differently than a plain, broad S&P 500 index fund. Some years it may hold up better. Other years, especially when growth stocks are leading, it may lag. The point is it's a different mix, not a free income upgrade. Third are preferred stock and income ETFs. If you've never heard of preferred shares, think of them as something in between a stock and a bond. A few tickers people recognize in this category are PFF, PGX, and PFFD. A regular stock is the ownership piece. You're along for the ride as the company grows, and the price can swing a lot. Preferred shares are different. They usually pay a stated dividend, kind of like interest, and they often don't have the same upside as a regular stock. You're not buying it because you think it will double. You're buying it because you want the income. Now, here's why I call them rate sensitive. If interest rates in the economy go up, brand new preferred shares and bonds start offering higher payouts. That makes older preferred shares with their lower payouts less attractive. And when something becomes less attractive, the price usually has to drop to compensate. So even though it feels like an income investment, the share price can still move around, sometimes more than people expect. And here's another piece, credit conditions. If investors got worried about a company's financial strength, preferred shares can drop because that income stream is only as good as the company behind it. That's why preferred funds can look amazing when you focus on the yield, meaning the annual income you're getting divided by the price you paid, but rates and credit risk still matter a lot. Fourth are bond ETFs. Bonds are basically loans, and to make this concrete, big, widely known bond ETFs like BND, AGG, and LQD commonly pay out monthly. When you buy a bond, you're lending money to a government or a company, and they pay you interest. A bond ETF is just a basket of those bonds bundled together in one fund. And because bonds pay interest regularly, a lot of bond ETFs pass that interest through to you every month. So monthly payments here are totally normal. But here's the beginner trap. People see the monthly interest and assume the value can't really drop. It can. Bond prices move mostly because of interest rates. If new bonds are being issued with higher interest rates, your older bonds with lower rates look less attractive, and to make them competitive, their prices usually fall. So yes, you may still receive the monthly interest, but the share price of the bond ETF can go down at the same time. That's why with bond ETFs, you can't just look at the monthly payout. You still have to care about total return, which is the interest you receive plus whatever happened to the share price. Okay, so now you know the buckets. The next step is deciding whether any of this helps your specific plan, and here are the 3 tests I use. Test number 1, what is the distribution made of? Some of what you receive may be qualified dividends, which can be taxed at long-term capital gains rates if you meet the requirements. Some of it may be ordinary income taxed at your regular tax rates. And some funds can include return of capital, which is literally a return of part of your investment and reduces your cost basis. So don't fall in love with a headline yield. First ask, what kind of income is this on my tax return? Test number 2, does this increase your control or reduce it? In early retirement, control is a superpower. If you're living off taxable investments, selling shares can be flexible. You choose how much to sell and you choose the timing. Monthly distributions aren't like that. They show up on the fund schedule whether you need the cash or not. That can be convenient. It can also be annoying in years you're trying to keep income lower on purpose. Which brings us to test number 3. What does this do to your planning numbers, especially taxes and MAGI? If you're managing MAGI for ACA premium tax credits, forced distributions can make your life harder because they add income you didn't choose. Even qualified dividends, while taxed at a lower rate, still show up as income on the way to your adjusted gross income. So here's the simple way to think about it. There are 2 different goals people mix together. One goal is getting cash flow in the account every month. The other goal is funding your spending in the most efficient, flexible way over decades. Monthly income ETFs can help with the first goal, but they don't automatically win on the second. Let me give you a clean example. If you want $6,000 a month, you can either build a portfolio that throws off monthly distributions, or you can build a portfolio for total return and then create a paycheck by selling a small amount each month. Both can work. The difference is control. The monthly distribution approach can reduce decision fatigue. Money shows up and that feels good. The sell a little approach can give you more control over taxes and timing, especially in the pre-Medicare years when you're trying to manage income on purpose. So where do monthly dividend ETFs actually make sense? They can make sense as a smaller allocation, not as your whole plan. A portion of your portfolio that throws off regular cash flow can reduce stress and keep you from panic selling in bad markets. They can make sense with smart account placement. Strategies that throw off a lot of ordinary income may be better in tax-advantaged accounts than in a taxable brokerage account, depending on your situation. And they can make sense when you're honest about the trade-off you're buying. Covered call funds may trade upside for cash flow. High dividend funds may concentrate you into certain sectors, and preferred funds may be rate sensitive. Bond funds can drop when rates move. Now, 2 mistakes to avoid, and then we'll wrap this up. Mistake number 1 is chasing yield. A high monthly yield is not a prize by itself. It's a clue that you should ask, where is this coming from and what risk is being taken to produce it? Mistake number 2 is confusing cash flow with safety. Monthly payments can make a volatile strategy feel calm, but the market doesn't care how often you get paid. Total return still matters. So here's my bottom line. Monthly dividend ETFs are tools. If you want the paycheck feel, you can use them, but use them intentionally. Know which bucket you're in, know what the distribution is made of, and think hard about control and taxes. If you're trying to manage modified adjusted gross income for Affordable Care Act planning, be especially careful about building a portfolio that forces income on you every month. That's all on this topic, but speaking of MAGI, I do have a freebie to share with you if you need to track it throughout the year, perhaps to maintain ACA subsidies if you're on an ACA plan for health insurance. Download my free MAGI calculator Excel template. There's a link in the description or show notes. Also take advantage of a free checklist I have too. It's called the 12 Must-Do Steps to Retire Sooner and Smarter. It offers a quick, practical guide to retiring early, and you'll find a link to that in the description or show notes as well. And when you're not on the go, check out my Early Retirement Roadmap podcast and go to mikeupland.com for all of my media. Well, that's all for today. Thank you so much for listening, and until next time, take care and make the most of today.